After doing a quarterly update on cybersecurity company Fortinet a couple of weeks ago, I've received a couple of requests to do uh, a deeper update on some other cybersecurity stocks I like. Now, this channel is Chip Stock Investor, but I feel like I can justify doing some cybersecurity stocks because a couple of these, my two favorite, do a lot of work with computing hardware. So Fortinet did a couple weeks ago. Today, let's take a look at Palo Alto Networks, ticker symbol PANW. Together, these two companies are my top two bets on cybersecurity. Let's dig in to Palo Alto Networks here for just a few minutes. Before continuing, let me remind you to hit the like button and subscribe to the channel if this video is helpful as you do your own investment research and increase your knowledge of business and technology. We really appreciate the support as subscribing to the channel helps us continue putting out content like this. Now, when I did the update on Fortinet, we had not finished the semiconductor industry flowchart yet. So let me just give you a quick update here. Fortinet designs its own custom chips that it uses for its network security and cloud security devices or firewalls. Those are an actual physical device, or sometimes now these days a software device. But for our purposes here, we're talking about the actual physical firewall or the physical hardware that powers the software-based one. And Fortinet designs the chips for those, a custom CPU. So Fortinet is most definitely a user of EDA software, a user of chip patents. You could also consider Fortinet a type of fabless chip designer as a result. And then, of course, they are very much a tech equipment and device company. So those three boxes on the right-hand side of the flow chart above the big computing system companies like data centers and ISPs. So that's where Fortinet lies. Now, as for Palo Alto Networks, this company is also maybe sometimes referred to as a legacy cybersecurity company like Fortinet. That's because they were founded in an era that predates cloud computing. So Palo Alto Networks, also historically a network security company. As far as I know, I have not seen them report anywhere anything about custom chip designs or using any sort of chip patent to do any custom work, but they also design firewalls and sell physical products. So you can bet they probably use EDA software, and as a result, they also fall into this middle right purple section here, tech equipment and devices. So that's where Palo Alto Networks and Fortinet would fall on this industry flowchart. Now, I'm going to debut here another industry chart. It's not really a flowchart like the semiconductor industry one, but Casey put this together just illustrating on a very high level basis all of the different type of cybersecurity services that are out there. Again, this is very broad, but these little bubbles here illustrate the different parts of the cybersecurity market, approaching a $200 billion per year industry, growing in a low teens average annual growth rate. Fortinet and Palo Alto Networks here, you can see the network security bubble. That's historically where they lie. Both of them have branched out into cloud security. It's a natural fit. Data centers, the computing unit for the cloud, need a physical firewall, a network security device. So it's a natural fit for them to expand into cloud security. Now, when I did the Fortinet video, I explained how Fortinet has largely grown and expanded organically. It has put a lot of money, a lot of effort into developing its own new cybersecurity services. Palo Alto Networks has come at it from a very different angle. Specifically, when current CEO Nikesh Arora took over a few years ago, he went on a spending spree, acquired, at this point, over a dozen smaller upstart cloud cybersecurity peers. It cost a lot of money, many billions of dollars to do it, but it's starting to pay off. So Palo Alto Networks now falls not just in network security, not just cloud security, but it dabbles in just about all of these aspects of all of these different parts of the broader cybersecurity market. That's really important because with inflation, the economy slowing down, a lot of big businesses are looking for ways to save money. Now, they can't just scrap a cybersecurity plan. Cybersecurity, obviously, in today's digital world, absolutely essential. You have to have it. But one way companies can save a few bucks is if they hire a vendor that can provide a little bit of everything that they need. You'll hear CEOs like Nikesh Arora on earnings calls refer to this as vendor consolidation. Basically, instead of having a bunch of different vendors provide you each little piece of this puzzle, you get one vendor that can provide most, if not all of them, for your business. This is a trend that has been playing right into the hands of Palo Alto Networks. I'm showing you now a slide from Palo Alto Networks' last quarterly earnings update, the second quarter of fiscal 2023. This is for the 3 months ended in January 2023, so just last month. You can see here in the top left, they have a little bar chart showing their total revenue and the year-over-year growth rate. So 26% year-over-year growth rate in the latest quarter to almost $1.7 billion. Palo Alto Networks is actually the largest cybersecurity pure play business out there. Microsoft is actually the largest. They said they did $20 billion in revenue in 2022. Palo Alto Networks, a very distant second place behind Microsoft, but nevertheless, it's number one in pure plays. Fortinet is number two as measured by revenue. But you can see that really nice, consistent revenue growth rate over the last year. And they think that that is actually going to continue for some time. I agree based on a couple of things here. So first, you see the top right bar chart, next gen security. A lot of that are those acquisitions that the company made the last few years of those small cloud computing and other cloud-based cybersecurity peers. You can see the annualized revenue run rate of about 2.3 billion in the latest quarter, up almost 70% from where it was a year ago. So that is really what is moving the needle these days for Palo Alto Networks. And then what gives me confidence that this company can continue to grow? Total billings, that's the yellow in the bottom left. You can see, again, nice consistent growth of billings. That's services that have been invoiced to customers. And then on the bottom right, remaining performance obligation in green, or RPO. That is a total of both billings and future service that has yet to be invoiced to customers. So again, nice, consistent growth rate in RPO for the company. Basically, they have a nice backlog of business in place that they will continue to convert into revenue for the next couple of years. I think what this translates to is what I think will be an average of low 20%, maybe high teens percentage revenue growth rate over the next 2 to 3 years. That's what Aurora and the top team's forecast has been, and I think they will be able to deliver that. One more slide I want to show you from the latest earnings presentation, the company's adjusted earnings per share growth and the company's free cash flow growth over the last year or so. You can see the growth rate especially has picked up the pace here in the last few quarters on both metrics. Actually, specifically on free cash flow, you can see the 2.7 billion generated in the last quarter. That's the bar charts on the right-hand side that you see. Free cash flow profit margin was quite high, mid to high 30% range for free cash flow profit margin. This is really important because I mentioned earlier, all those acquisitions they made starting a few years ago were quite expensive. Many of them were paid with the issuance of new stock. And this is a touchy subject with a lot of investors these days, especially given the bear market. Everyone has their microscope out and has it trained on profitability. Nikesh Arora is a former executive at Google. He spent some time at SoftBank on the Vision Fund. He understands how to make acquisitions and how to make them profitably. And we're starting to see that vision he had for the company pay off here, I think, in spades. So on an adjusted basis and on a free cash flow basis, really strong growth. There are some issues with that stock-based compensation, but the company has been repurchasing stock using free cash flow to offset the stock-based compensation. Stock-based compensation, we're going to put a link here to the video that we made a few months ago about stock-based compensation, because it really kind of got its start. What we know as stock-based compensation today got its start when the semiconductor industry was born about 70 years ago. Got a link to that video here. But basically the point here is Nikesh Arora and the top team understand how to handle this. They've had a plan in place now for over a year to deal with it. And it all has to do with generating really robust free cash flow profit margins and using it to repurchase stock. Now, I want to show you one more thing here on my ticker terminal. This is the analyst, the average Wall Street analyst expectations for Palo Alto Networks. Now, I show this to you not because I want you to give credence to analyst expectations without doing your own due diligence, but here's why I'm showing it to you anyways. You can see here the revenue, the expected revenue increase, about 25% this year, dropping to 21, 22% next year, and then dipping into the high teens percentage. I think these numbers are doable because of that RPO bar chart I showed you a little bit ago. But here's what I think is interesting here that helps illustrate why free cash flow is so important for Palo Alto Networks and how it's helping the company manage that stock-based compensation. Let's drop down here to earnings per share growth. So the company just recently turned profitable on a GAAP earnings per share basis. That's non-adjusted. So I showed you the adjusted EPS and the free cash flow earlier, but here's the earnings per share GAAP. And you can see here last year they were still in the red, but they've flipped positive here as of late, and they're expected to generate positive earnings per share growth this year. And you can see the really dramatic increase here that analysts have forecasted over the next 4 or 5 years, depending on the analyst prediction and the year, anywhere from a very high, mid to high double-digit percentage year-over-year increase, or even a triple-digit percentage increase. Here it is in bar chart form. Basically, what's going on here is as Palo Alto Networks continues to grow its revenue, it's getting more efficient. And over time, Arora has said that they are going to manage down stock-based compensation to employees. Now, when you pair that with the share buyback program with free cash flow, you get these really, really dramatic year-over-year increases in earnings per share. So for the time being, I'm focused on free cash flow. I think it's the more accurate measure for the company when trying to figure out its valuation. But if you're worried about GAAP profitability, take a look at this chart when you're building a model and trying to figure out how to stick a valuation, a fair valuation on Palo Alto Networks if you're planning on owning this company for the next few years or longer. So as I'm recording this, Palo Alto Networks stock trading for about 19 times trailing 12-month free cash flow. Now, if you remember back to Fortinet, I explained its stock is trading for a premium, both on a GAAP earnings per share basis and also on a free cash flow basis. Right now, again, as I record this, Fortinet trading for about 34 times trailing 12-month free cash flow. It's definitely a premium. Again, I explained how they are also efficiently growing, scaling up their profit margins. So I think it's a fair value. But Palo Alto Networks, this one looks pretty cheap. I I sort of prefer Fortinet's business model and its focus on organic growth, but there's that premium price tag. If you're looking for something cheap, you might like Palo Alto Networks. Again, I own both of these companies. I buy both of them on a regular basis, add to my position. I plan on holding for the indefinite future. I think these two businesses are fantastic. A lot of investors get focused on some of these sexy, high growth cloud network security names like CrowdStrike, which I own a little bit of and have since shortly after their IPO, SentinelOne, Zscaler. A lot to like about those businesses too. But I really like the healthy and growing profitability of Fortinet and Palo Alto Networks. And again, that vendor consolidation thing, I think that's a trend that is going to continue for at least several years to come. And I think it plays into the hands of companies like Palo Alto Networks. So that's going to do it for today on this episode of Chip Stock Investor Cybersecurity Edition. Let me know what you think. Let me know your comments below. We can do more cybersecurity videos, but these are my top two far and away, Fortinet and Palo Alto Networks. So I hope this video has helped you as you do your own due diligence. One other final note here before I go. Jose Najarro, who I hope you're all familiar with now at this point, has a new site up and running. I am working with him on this project. The website is More Semi Investing. The link to that below in the notes and embedded here in the video. Basically, if you want more deep dives, more hands-on learning opportunities on the semiconductor industry from Jose and myself, that's not going to change anything that we're doing here on this channel, just sort of a value-added thing that both of us have been working on for a while now. Make sure you check that out. Thanks again, everyone, for tuning in. We'll see you again next time. Take care.